Austin Tech Connect is the official podcast of the Austin Technology Council. Founded in 1992, ATC exists to help unite the local technology ecosystem and to encourage the spread of community, collaboration, and conversations in Central Texas. This podcast is sponsored by SailPoint. They are a leading provider of identity security for the modern enterprise, empowering organizations worldwide to put identity security at the core of their business. With a foundation of artificial intelligence and machine learning, SailPoint Identity Security delivers the right access to the right identities and resources at the right time. Now, here is this week's episode.
Hey, and welcome to another episode of Austin Tech Connect, the podcast from the Austin Technology Council. Each week, we try to bring really interesting information that will help expose you to key people in our tech ecosystem who are doing amazing things. Now, today's episode is going to be a little different. Earlier this week, we hosted the 2024 C-Suite Summit and Industry Think Tank. And this podcast is actually the audio from the panel that was about the state of funding for growth-oriented tech companies. So please enjoy this panel discussion from the C-Suite Summit. So next up, we have our panel on funding for small and mid-sized companies, and I'd like to invite the panel to come forward. And I also would like to invite one of our panel members, Andrew, from MUFG, who is the sponsor of the panel, to introduce his company, since we are thankful again to them being a sponsor. And I want to make sure that we have that microphone, and I'll give this one to Andrew. Every one of you should have a mic.
Got it. Thanks, Tom. And there's actually two Andrews, so appreciate you finding the right one for this. So yeah, thanks for having me, Tom. So MUFG, we're a Japanese bank. We're actually the largest Japanese bank and effectively top 5 largest bank in the world. And I came over roughly about a year and a half ago, along with 30 colleagues from Silicon Valley Bank. So we were the corporate banking team at SVB, which was the later stage practice at SVB. And obviously that bank had some issues a year and a half ago, and our team had the opportunity to move over to MUFG to effectively be like a startup inside this massive institution. And so we've been very active at working with innovation companies. We are typically working with companies kind of 30, 40 million in revenue and above, and we're providing financing, lending, we're providing treasury services, transaction banking, and risk management, and then bringing kind of the full corporate investment bank solution and platform to all of our clients. So thanks again for having us, and looking forward to our panel.
Thank you. I'm excited to be here. My name's Linda Janak, and I am the CEO and founder of a company called Talent Guard. We use data and AI to drive upskilling and reskilling, and I think it's such a great topic today, following suit with Razat about growth stage and what it takes to actually grow your company. And our focus today is talking about how do growth stage companies use finance strategies to achieve that growth, whether it's through VC, private equity, debt, and what metrics are these organizations looking for as your organization continues to scale. So what I'm going to do is start with intros. Obviously, you just met Andrew. I don't know if there's anything else you want to say.
No, I'm good.
Okay, then we'll just go this way, and I'm having to have the panelists introduce themselves.
Sure. Super briefly, Andrew Vogley, investor at Sapphire Ventures. We are a growth stage venture capital plus growth equity firm headquartered here in Austin, significant presence in the Bay, New York, and London as well. So truly kind of a global firm looking primarily at B2B software businesses, largely enterprise, but kind of across the entire spectrum of all things software. I've been there for about 3.5 years. Again, largely cover a lot of kind of what's happening in Austin. Prior to that, spent time on the operating side, spent time in a business called Homebase that does small business software, and then went to the entire opposite end of the spectrum and spent time at Cameo doing celebrity shout-outs. So if you ever received a birthday shout-out, that was Cameo probably. And then prior to that, started my career in consulting. So super excited to be here and hopefully be somewhat helpful.
I didn't know you were at Cameo. That's really fun. I'm Jen Smith. I'm a corporate partner at Latham & Watkins. We're a global full-service law firm. I helped start the Austin office of Latham in 2021, so I've been there for about 3 years. But I've been in Austin working with tech companies like many of you for about almost 20 years now, helping them with fundraising, M&A. So Rosette, I'm part of the minutia of the law firms that can help you figure out that muscle if and when you get there. And IPOs. So happy to be here to talk about this topic.
Awesome, thank you. So we have banking, and we have VC, and we have legal. So if you have questions, please write them down. I think this is the audience that can answer them for you. So Jen, maybe you could just start us off with talking a little bit about the market trends that you're seeing.
Sure.
For growth stage companies.
Sure. So we should preface this by saying we have a very short time frame, and we could probably spend a day on this topic. So just at a very high level, what are our clients seeing now? It's been a rough couple of years, I think, to put it lightly, in funding, both on the venture and debt sides. But I think where we are right now, I think we're on we're almost about to have good news. We don't really quite have good news yet, but all the pieces are finally starting to align. What we're seeing is our clients have been raising a lot of inside rounds and bridge rounds on the venture side. Still not a lot of new money being deployed on new deals, but people are getting inside deals done. On the debt side, we're seeing more activity than we've seen in a while. So I have a number of clients who are raising funding for things like M&A or just to have kind of a revolver in place. So that had been pretty quiet, but I think the Fed move in September has really helped that. And the other thing we're seeing a lot of, which has been a dramatic shift in the last just couple of even weeks to short months, is private equity. So private equity buy-side activity is dramatically up. And one of the things, for those of you who don't pay too close attention to this, I'll just explain, is that we're seeing a lot of our venture funds, they haven't been able to return, and private equity funds haven't been able to return funds to the LPs for now a couple of years. And that is something that it trickles down into why venture funding has been so constrained over the last couple of years. And so private equity buy sides, ultimately that they buy from each other as well. So hopefully that helps to increase liquidity, which then increases money to flow to the LPs, which then helps money get kind of recycled into VC. So it's all these things are interconnected, but we're expecting, I think, improvements on a lot of fronts over the next 6 months, and we talk more about that. But I think kind of where we are today is things are still challenged, but starting to thaw a bit. And so I think the next 6 months should hopefully be an interesting time.
For sure. Now, are you seeing anything industry specific, something moving faster than others, or anybody else also from banking and VC?
So just from my perspective, I'll just start and say, even though it's an anti-buzzword today, AI is absolutely dominating venture funding right now. I mean, the stats are kind of crazy. I think I saw a stat recently that estimated that 40% of businesses that are getting new money, not the inside rounds, but the new money rounds, are AI businesses. And I think healthcare is still doing okay. We've seen a lot of energy tech deals getting done over the last year or two. Those are really the three areas that stand out from what we're seeing for our clients.
And I know Tom said don't talk about AI, but we certainly are seeing a lot of the AI opportunities on our side as well. And as a venture fund, right, you're trying to invest in things that have big outcomes, and AI at least promises the potential of big outcomes. But I will say we are seeing a lot of opportunities as well in industries that have been less traditionally venture invested in. So folks applying software to, call them quote legacy industries. We've looked at things recently in agriculture, supply chain, et cetera. And I think there's a lot of activity and excitement in those spaces as folks realize, hey, there's really a lot of powerful things that technology, in particular software, can do.
What about keeping on the same theme of some trends, and are we seeing any different financing vehicles or strategies for growth?
So yeah, I mean, there's definitely a lot of different flavors out there for financing and how you want to think about it. So there's what a lot of you are probably very familiar with, which is traditional sort of venture debt, right? So you've raised a seed round or your first couple rounds of institutional equity, and then you decide to take something a little bit less dilutive. So you go to the traditional venture, and a lot of times that's been, a commercial bank type of lender, but there's also a lot of direct lenders, which are private private finance companies. Those institutions have been very active in the space as well. And then there's different structures as you continue to mature on your journey. So you get kind of from the venture debt side. Eventually, you might take that out with a more traditional kind of 5-year bank type of loan. And sometimes those structures where a bank might do it themselves, or a bank may even partner with a junior capital lender, or do it themselves. It really just depends on sort of how risky that transaction is and kind of how much debt you're actually looking to take on. So yeah, there's definitely a lot of different ways. And, as you're getting very large, I mean, kind of like Plan View, right, who's got significant sort of institutional debt, and you kind of get to that level, and then sort of the next level when you do an IPO, you kind of pay some of that down and you keep some of the debt on your books. But there's definitely a lot of different flavors of financing that's out there.
I would just add to briefly. I think we're seeing a lot more folks just become more creative with the types of financing that they're attracted to or interested in. It's really about aligning incentives, right? Which means understanding your incentives and then understanding the folks across the table. I have a friend who recently took media dollars, if you will, from one of our LPs. They own a ton of kind of broadcasting stations, and he runs a consumer business. And it didn't make sense for them to put capital kind of off their balance sheet into the startup, and he didn't necessarily want that type of dilution, but they came to a really creative partnership where they said, hey, you give me X million of free media spend in exchange for kind of this portion of the company structured in this way, which I had not seen before. And of course, this has happened before. It's not a totally novel idea, but I think, 2 or 3 years ago, he would have just raised another round of traditional venture funding, which could have been great. But I think this was a very targeted way to kind of truly align incentives for the media company that wanted these types of advertisers, these types of companies on their platform. And then for him, as he grows his company, this network has the exact kind of user base that he wants to be targeting. So I think we're seeing a lot of really interesting approaches on that front.
Yeah, that's really one other thing I would add is, and this isn't necessarily something you want as a business operator, but as a way to align or bridge the gap between maybe your valuation expectations, which might be pretty high if they were established anywhere near 2021, and your investors' valuation alignment or expectations, is we've seen some kind of milestone-based investing that tries to help bridge the gap. It's a little bit like an earn-out in an M&A deal where you have one party that thinks something's valued at a totally different price than someone else, and so it's interesting because venture deals tend to be pretty plain vanilla, and that's actually kind of how you want them. You don't want them to be too distracting for your operators. There's NVCA documents and other things that are sort of well-trodden paths toward funding, but in the instance where you can't get a valuation alignment, there are ways where you can create sort of check-in points that, has the business done what it said it was going to do, and does the valuation still make sense, but maybe get some certainty around the deal. So we've seen a little bit more of that right now, given the market. I don't, if you can get to a cleaner deal than that, it's certainly better for you as a company, but there are ways to think about it that might be able to help you.
Yeah, we're VC backed by Live Oak, and they're a pretty conservative organization, and we had some good growth, but one of the things we had to think about while the market was still a little bit cold is how, what can we do internally to drive growth beyond gated growth. And I thought, well, we have a couple customers that are very, very large. They have venture arms, and so we went to a couple of the venture arms pitching there, and I didn't think we'd get any bites, but we did. So there are some interesting opportunities there for entrepreneurs who are thinking about growth. And if you're not getting a bite with the VC market, or you can't get any debt right now, those are some potential ideas that you could also think about. And I'm in this situation now where we're EBITDA positive, we're still growing, but we're not yet getting the funding. So as a growth company, how are you thinking about the trade-offs between profitability and growth? And maybe Andrew, we'll start with you.
I think this is always the $1 million question, right? Of how you balance those things. I think I'll preface everything I say by kind of framing it as venture investors. Ultimately, frankly, we make money solving for large outcomes, right? That's kind of how the business is structured. Those are the kind of risk profiles that we take on in companies. And so growth is always an important part of the equation. That's not to say there are truly kind of, and I think this is an important point that we'll discuss, there are investors for kind of every point in the if you think of growth and profitability as a spectrum kind of sliding scale where you can, if you have good control of the dials of your business, you can kind of tune them as you see fit. So there are investors at every point along that spectrum. Venture folks certainly fall on the growth side. But I think the key thing that we really think about is, what is your market opportunity, and then roll backwards from that. If you see a large market opportunity, we're going to encourage you to grow fast, capture that market opportunity, and especially as kind of growth stage venture investors, by the time you get to us, there's a real product, a real platform, and real customers. And so from there, it's looking at kind of that unit spend. Are you able to acquire customers efficiently? Are you able to, as Razat said, retain them efficiently? Because the leaky bucket is the worst enemy of anybody in a software business. And if those things are in place, then we certainly will kind of push you, hey, let's responsibly grow and burn money, because we see that large opportunity in front of you. I think where we sometimes push folks more towards the profitability side is if, hey, maybe the market opportunity is not as large as we maybe originally thought, in which case let's think about kind of how do we capture that opportunity in an efficient way. And so everybody is kind of along the spectrum of, what are you solving for personally, right, as a founder and as a management team? How big is the market opportunity? And have you built a product to date and a platform to date that has shown that you can kind of efficiently capture that market opportunity? So if you have big vision, big opportunity, and you have really good proof points, I think generally speaking, folks will encourage you to grow, just because that's how the venture model is set up. But at Sapphire, we also have kind of what we call growth equity, which kind of a confusing name, but typically businesses that are more profitable than venture businesses or venture-backed businesses. So usually not burning, usually have some level of profitability, but might not be growing as fast. And the calculus there is a little bit different, where I don't want to say formulaic, but you can get really precise on kind of, hey, every level or every point of growth that we try to take off the business will correspond to this level of profitability. And those businesses do tend to be valued more on an EBITDA basis. And it's all kind of within bands, right? It's, hey, if I'm a 40% grower with 10% EBITDA, I kind of get put into this bucket by investors, right? Versus if I'm a 60% grower but break even or slightly burning, I'm in this bucket. Or if I'm a 20% grower with 30% EBITDA margins, I'm kind of in this bucket. And so investors are always trying to put you into one of these buckets to understand, hey, what is this business ultimately shooting for? Because that ultimately is how you think about the value, right? And that's ultimately, you kind of work your way backwards from that as an investor to try to figure out, how do you value and ultimately decide to invest in something.
And Andrew, do you think, so what I am observing, I think, is that companies are being held right now, given the conservatism of investors, to being at a slightly more EBITDA-focused part of the spectrum than companies at their stage normally would. And so, for example, if you have Series A or Series B stage companies in this audience, typically I would not expect them in their fundraising to be super focused on break even or EBITDA, but they're mostly focused on growth rates. And I'm seeing some of our clients who are out there raising money right now answering questions from investors about, what's your EBITDA profile look like? And so for those of you in the room who are sort of at a Series B, even Series C stage, where typically I would say, that's just like, how many sales guys can you hire, and and how much money can you throw at the sales organization? Those types of conversations. I'm at the current moment in time, I'm not really seeing quite as much of that. I'm just curious if that's representative of how you would think about it right now too.
I think that's right, and I think there certainly was a period in time where it was, let's stabilize kind of everything in the portfolio. We didn't know kind of how long this tech recession would last. We didn't know what the funding environment was going to look like, and so it makes sense to kind of take a little bit more of that conservative posture. But as things start to open back up, again, it goes back to the original point of, as venture investors, we're solving for those big outcomes. And ultimately, you can only grow your way into big outcomes. You can't, profitability your way into big outcomes. And so we are seeing more excitement around things that are growing at a high clip. I don't think we'll ever get back to, well, ever is a famous last words, right? But I don't think in the near term or medium term we'll see kind of the 2020, 2021 levels of growth at all costs. I think folks have generally learned that lesson of, hey, let's make sure we're a little bit more measured in that approach.
Yeah, to layer on top of that a little bit. So on the lending side, 2019, 2021, that vintage of company where it was that growth at all costs, and we were looking at companies lending, right? And it was kind of like these companies were burning for life. And that's how we would look at them and talk about them. And people were able to actually get leverage and get debt based on that. But given what's happened since then and the slowdown in VC investing, that has really changed and kind of flipped. And so it is this idea of profitable growth. So as a lender, we want to see growth, and we put companies into different buckets. Are you mid-single digit growth? Are you mid-teens, or sort of 20% plus? And those profiles all sort of have different metrics that we would look at in terms of how we think about lending to that company. But we're all sort of looking for companies to drive themselves to break even and then profitability. And while it's positive EBITDA, it's also positive free cash flow. So in I'd say the sort of post-SVB regulatory environment, there's a lot of there's a lot of things being driven towards looking at companies' ability to repay their debt using free cash flow. And that's obviously kind of a 5 to 7 year look, but you need to be able to show and demonstrate that your business ultimately has the ability to truly generate positive cash flow that can ultimately repay the debt and not just look to the next round of equity to kind of cover the debt.
And Jen, following on to that, you probably have an interesting perspective because you can work with a lot of the VCs, the banks, and the entrepreneurs, and you're in the boardrooms oftentimes listening to the conversations that are going on. What kind of advice do you give, or are you seeing their board members give the entrepreneurs about thinking about which vehicle to choose when they're confused or they're just not certain?
Yeah, I mean, it's tough. I think right now, if you're kind of in the stage of company that we've been talking about, I mean, it varies widely. If you're Plan B, you're having a totally different conversation than you're having if you're a Series B or Series C stage company, which I think more of you in the room are. I think a lot of times you're having both conversations simultaneously, and so you're in a room, and there's really no reason why you can't. I mean, you get to about that stage. About that stage, I think, is when companies really start to think about inorganic growth. They think about sort of other things they're trying to do, and so just trying to capitalize their balance sheet as much as they possibly can. At this moment in time, you have a lot of companies who haven't really been able to raise venture or debt capital for the last 18 to 24 months, and so they've just been sort of holding on for dear life for the last 2 years, trying to just extend their runways as much as they possibly can. And so now that people are are lifting their heads up, I think they're trying to come up with a way to leverage both debt and equity checks for growth. And so I think it's an interesting question. We started talking about this in some of our prep work, and I think it'd be interesting to hear from both Andrews up here about, how you position venture versus debt. At certain times, one is much more expensive than others, but they sort of have pros and cons in each. But I think at a certain stage, we're advising our clients, you have to have the capital to scale, and so you want to try to get it from anywhere that's reasonable at that stage. So I see a lot of companies looking at both simultaneously, actually, and then sometimes executing on both simultaneously.
Yeah, that's good. So in the audience, I think it'd be interesting for us also to know how many people are fundraising right now. We got a lot. For Series B, growth, debt, financing. It's interesting. We're all in that same boat thinking about what's next. We've got the election coming up, obviously, and I think we're all hoping that the markets will change with that as well. But if we start thinking about the future, the market outlook, maybe I'll start with you. What are your leadership? What are they talking about? What are they hoping evolves? What are they seeing evolving based on some of the research that you're putting out there?
So it's obviously a good question. Everyone talks about rates, right? So it's all from our perspective, and that everyone wants to know where a rate's going to go. You can go look at the Fed dot plot and see where people think rates are going to ultimately shake out. But certainly, as rates do come down, it does make it a lot more palatable, and just for higher growth companies in the tech sector to be able to just basically handle their debt service, right? Because you got to pay interest, you pay amortization, and so you need to be able to actually service that debt in addition and continue to grow. So you don't want to constrain yourself in, going to bed every night thinking, how am I going to make my interest payment tomorrow? That's just not a good situation to be in. So I think, we're all looking at a lower rate environment in, the near future, whatever that may look like. And so that certainly will help jumpstart, I think, valuations. It'll help with which then ultimately flows into M&A. So I think we all feel like 2025, maybe the second half of 2025, things will pick up at a little bit more of a robust pace than they are now. And look, nobody has a crystal ball on IPOs, but I think that, I think we all think that window may again look to open up, and, it could be a year from now. And look, those companies aren't going to be like they looked in 2019 or 2020 when you had barely hit 100 million in revenue and you went public. Like, they're definitely going to be much more scaled businesses that are able to go public, and are able to just really continue to kind of show high growth, but just strong cash flow generations.
And I would add to that. So Latham does, I think, more tech IPOs than anybody in the world, and so we see a lot of sort of the behind the scenes who's in line to go public. And what we're seeing is a first half 2025 pretty significant. I mean, we're seeing a ton of companies right now actively getting ready. I think if you look at the timeline and you go back to sort of Q1, if you're familiar with IPO calendars, people sort of tend to look at the summer, they want to be out before the summer, or then there's a window sort of shortly after the summer, but then you got to be out before the holidays, and based on financial accounting calendars. The point being that when you were looking at early 2024, people were still a little bit cautious. Then you look kind of shortly after the summer and everyone said, oh no, like the election's going to be there. We're not going to go out right before the election. And in fact, Q3, I think there were 13 IPOs in all of Q3, so that tracks. And so everybody sort of looking at this at Q1 2024 got pushed into Q1, Q2 2025. So that's still, everything that was true in Q1 2024 is pretty roughly kind of as good, or in some cases a little bit better from a capital markets perspective going into Q1 2025. And so what we're expecting is a pretty significant uptick in IPO activity in Q1 2025. And that should have, again, trickle down impacts into the other types of things we're talking about. So I'm even a bit more bullish maybe than you, Andy. I'm an eternal optimist, so take that for what it's worth.
That would be awesome. So when we're thinking about the Austin market compared to, some of the other regions, are you seeing any trends in any key areas like New York over California, Austin, in terms of where these IPOs might be coming out of, where the investments are going to be made, where they're getting the debt?
I mean, I would say my observations are mostly U.S. based, so I'm sort of hedging, and I'm not talking about sort of the international community, but I think it's going to be more industry based than it is geographically. Once you are only talking about the U.S., but I don't know, Andrew, if you have a view.
I would say just more broadly, I think folks have realized you can build great companies outside of the Bay Area. That's part of why we opened an Austin office here a couple years ago, and certainly y'all know this better than anybody else. But I think there's more and more excitement as we kind of go around the country, frankly, and kind of see these different pockets of opportunity. It's clear that Austin actually has really emerged as a place where you can build a highly ambitious company and find the people to kind of staff it and then go attack the problem. So I would say we're certainly bullish here, and I think broadly, we kind of see that across the broader U.S. landscape, but I think particularly we are excited about what we're seeing in Austin.
Yeah, on a regional basis, I'm not sure that I really could say that one area is going to be more robust than the other. I would say that I cover for the bank, so I cover the Southeast, the broader Southeast, and Texas. And it continues just as you would think about population flow. It's just that region is been very is high growth. A lot of companies have either moved out of New York or the Bay Area or wherever to somewhere in the Southeast. And so I would imagine that a higher share of these companies that are going to go public are actually all like Bay Area or more mature markets like a New York or a Boston.
Yeah. So what are some of the key takeaways that each of you would give entrepreneurs and seasoned CEOs when they're thinking about fundraising in terms of their books, their strategy, their leadership team to be on top when they're ready for that fundraising?
Maybe the biggest piece of advice I have is just understand and kind of have really been thoughtful about what you as the founder, CEO, management team, et cetera, are playing for, and really work backwards from that. And then similarly put yourself in the shoes of the investors that you're targeting, whether it be kind of traditional venture capital, whether it be growth equity, whether it be private equity, and understand kind of what they're targeting as well. And more times than not, there is that intersection of, where everybody's kind of interests do align, and it's just a matter of kind of sometimes wandering through what feels like darkness to get there, but really just kind of being honest with yourself of, hey, I'm okay with this kind of exit, or I'm willing to kind of risk it all to get to this really big outcome because that's what I believe and this is my life's work. We're going to go do that. Great. And so then you just need to make sure you've kind of aligned yourself with investors that are appropriately kind of ready to support you throughout that entire journey.
Certainly Jen can talk to the legal side of your house about what you need to do, but from our perspective, number one, get audited. Get an audit. We see a lot of early stage companies that don't have audits, and if you want to work with a commercial bank, we just literally can't do a transaction unless you have an audit. So you do need to get audited. It's good practice to work on your on projections, being able to actually build really good, robust, 5-year projection model that effectively has all kind of 3 financial statements, your income statement, your balance sheet, and your cash flow. So make sure that you really are adept at being able to do that and to be able to demonstrate to investors and to lenders that you can truly kind of project out the visibility of your business. I think that's really critical as you think about that. And then also just your corporate structure, just making sure it's in pretty good order, and I can let Jen talk more about that, but having just a kind of as clean a structure as possible with sort of the right entity set up is also really helpful.
Yeah, well, you're not going to have to push me to say that you need to have your house in order to try to get a deal done. But I will say that now it's more important than it was a few years ago. So if the only time you've ever raised money was in 2021 or 2020 or 2020, even first half 2022, or if it's been a long time, because of how conservative investors and lenders are being right now, things are just more difficult. And that also means that people are doing a lot more diligence. So if you raised money in 2021, you might have gotten a term sheet and had somebody not even have time to really barely talk to your management team, much less spend a whole bunch of time on your, on your records diligence. And things are just not that way anymore. So I would just sort of say I hate to say this, but it's harder than it has been in the past, say, 5 years, and that's both in terms of time and commitment from the management team, so in terms of distraction from your business and in terms of making sure that you have everything in order. Just setting your expectation that it may not be as easy as it was the last time, I think is important because it may help you not get as frustrated as you otherwise might. It's doable, but it's just going to take more time and energy, I think, than what you may have been used to from your past, unfortunately.
Yeah, that's a tough one too, because when you're focused on your short-term wins, you've got your long-term goals, and you mentioned several metrics when you were walking through, like what you look for, and you were talking about making sure the retention is there and the ARR. You've got your growth, your customer logos. Is there a sweet spot that you're thinking about if you had to prioritize, your top 5 KPIs, or does it really depend on the business?
The answer is yes, and it depends. I think growth, again, from the venture mindset, growth will probably always be the most important one. But we've also kind of mentioned it here. The retention piece is really key, and I think particularly that gross retention. Certain businesses, depending on kind of where you are in the journey, as you kind of build product, you might not have that net retention kind of where you want it to. But if customers are sticking with you and you have built a platform that they come back to, day in and day out, those are things that to an investor are really attractive. And so kind of we think about best in class gross retention as being above 90% on an annualized basis. And again, it kind of depends on what type of business, what segment, because certainly when we look at something that is more enterprise oriented versus something that is a little bit more SMB oriented, if you're an SMB business, selling restaurant tech, if you're above 80%, like that's incredible. And so it really does kind of depend, but I would say that the two that we really key on, particularly this environment, is are you still showing that growth and are customers not churning, which shows up in the gross retention.
Yep.
Yeah, I mean, we look at those as we look at the revenue, we look at your gross margin as well. That's pretty important to us because somebody says they're a tech company, but then they come in with 30% gross margins, and that's not really, you're somehow tech enabled, but you're not really a tech company in kind of our vernacular. We also look at LTV to CAC. I mean, that's important as well, in addition to kind of gross and net retention metrics. So we definitely look across the spectrum, but similarly, it doesn't mean that it's not a great company if it doesn't meet all of those metrics. It just means that from our perspective, we may do max leverage for somebody that just hits every one of those criteria at the maximum level. So we still may be able to find a way to say lend to somebody, but it's just going to look different. The structure of the deal is going to be different based on where your metrics shake out.
Awesome, thank you. So maybe we could leave the audience with a key thought before we open it up for Q&A. Do you want to lead us, Jen?
Hang in there.
Yeah, that one. I think we've been told that for so long.
I mean, I know. I feel like I've been on panels for like 3 years and people are like, no, it's going to be next quarter. No, it's going to be next quarter. I haven't said that yet on the stage, and this is the first time I'm going to say it. I actually think we are on the verge of things getting a little bit easier, so I'd say hang in there.
Hang in there, and I think as an investor, we try to really take the time to realize y'all are the ones doing the hard work. It's easy for us to sit up here and pontificate on, hey, you have this little wart in your business, or this should be a little bit better. But at the end of the day, if you feel like you're building something interesting and customers are responding, then the rest will take care of itself.
Mm-hmm. I mean, I would say at some level, there's always an opportunity for you to look at getting funding. And so it really just depends on where you are, what you're thinking about, and what the metrics and the profile of your company really look like. And we've been at this only for 18 months at MUFG. We've been really busy, and we closed almost 40 deals, put out $1.5 billion in capital. So there's stuff to be done. Like we're active, and we do see a lot in the private equity market. There's a lot of private equity companies trade portfolio companies among each other as exits because there's no real robust IPO window at the moment. And those valuations have certainly come down from where they were 4 years ago, but there's a lot of deals still getting done. So I'd say, just keep operating your businesses and make sure you surround yourself with good people.
Yep. Awesome. And Tom, I think we'll do some Q&A, but while you're working on getting that funding, I think we've got some great advice here with those 10 tips. They're pretty straightforward. Some business fundamentals about what it takes to have focus and put your employees first and put your customers first, and it drives business success. But sometimes when you're so mired in the details of focusing on your funding and your growth and what's going to come next and how are you going to keep operating the business, you can lose sight of those. So I do think taking those 10 tips, they're for any stage company, and really getting your book of business together, that's going to help with your growth story. So we'll open it up for questions.
Say your name.
Yep, John Warner with Fiesta. So the question is, given, I guess the feds in particular are coming down hard on big tech companies and M&A, what do you see changing potentially in the first, second quarter of next year, if anything, towards more M&A activity?
I would say maybe one area, and we talked about this a little bit, but I think private equity is becoming increasingly active, and so perhaps you're not getting the strategic M&A that you would with a large technology company, which again traditionally have been very good for driving outcomes in at least venture capital. But I think more and more there's an emergence of kind of tech private equity that is realizing, hey, these are great businesses that are worth buying and kind of being long-term investors in. And so I think that's kind of one outlet where we've seen some of our portfolio companies go that way recently and are excited to, in many cases, partner actually with more of those firms because they do bring a certain set of expertise and capabilities that even if we wanted to, roll some of our stake in those companies, that's a really good opportunity. So I would say who knows what if there's a change in administrations, what the regulatory environment looks like. I'm certainly not an expert in that, but I think there's real opportunity on the private equity side to be a real buyer of businesses.
I mean, I would note the regulatory environment, which we haven't talked about at all here, has been incredibly challenging. This is only for pretty significant deals, and it's for M&A, so it's kind of a bit outside the scope here. But to that question, I think a change in administration could have a dramatic impact on the regulatory environment for M&A. I would also say the focus does seem like it's on a pretty small handful of big tech companies, and so I think while those companies do tend to be pretty active, I don't think it necessarily proliferates into impacting other types, and in fact may create more competition among other types of buyers of tech companies. So I'm not I agree with the private equity point, though. I think that's really a meaningful outlet, and private equity tends to be more spread out by definition, and so not necessarily going to step in quite as much regulatory red tape as what your strategics are going to be, especially the bigger ones.
Tad Drew, Pierpont Marketing Communications. Razat mentioned culture on that. We're doing a lot of M&A work, communications right now. There's a deal that's close to falling apart because of one company went to entirely remote, the other company entirely in person, and they're coming together and it's not working culturally. Do you guys get involved and how much do you look at when you're looking at investing or doing that, the culture of the two companies that are coming together?
I will say, so traditionally our companies have not done a ton of M&A, and that's partially just kind of the scale that they're at. But we certainly look at, when we're considering an investment, how is the company set up? And I don't think there's necessarily a right or a wrong way between, hey, we're all in office, we're a hybrid, or we're fully remote. I think the biggest thing is, have you committed to a path, and are you fully committed to executing it well? I mean, again, we have companies in the portfolio that are fully remote, and they operate at some of the highest levels. But then we also have some that are in the office, 4 days a week, and have also operated at really high levels. And so I think it's much more about being just kind of choosing a path and sticking with it. And there's pros and cons to both. So I would say it's about kind of the commitment level to what you've kind of chosen as a practice.
I know there was a company that I was with, and we had acquired another company, and we hired them they had this really cool it was a fintech portfolio, and we were a life planning event company. And even though the technology was sexy and they had great revenue, we did the deal, and the deal fell apart in the first year, and it was a huge disaster. And it was right before dot-com bust, so it was even worse because we were going out for, I think it was our Series D, and we were raising like $150 million or something, and that was awful. So sometimes you want to catch those things ahead of time because once they go through, it can derail worse than probably before. So,
I'm David Smith. My company is IBEON Holdings. Question probably for Jen and Andrew Moore. We've had multiple investment checks being held up by regulatory compliance coming out of the MENA region and out of Asia. One of them has been there for over 4 weeks now. Is there anything we can do to work better on the international basis? Because it seems like in the last couple of years, the holds on international checks have just gone tremendously high. And one of these is for 10 million, one's for 35 million, and they're just sitting there.
I mean, that's a very specific question. We should probably talk about that after. But I do think international, it's maybe, I don't know if it's banking KYC type things that are holding it up or not, but that's, Homeland Security. That's I'm happy to help you chase down an answer to that question. I don't have it right now. If I had a magic, I will say that's consistent with experience we're seeing others have, that there's just things are hard, especially internationally. That's absolutely the case. I don't know that makes you feel any better or not, but that you're not alone. If I had $45 million just sitting at other places trying to get wired into me, I'd also be pretty upset about it. Off the top of my head, I don't have a great answer, but I will give that some thought in case we can come up with something for you.
Yeah. One more question.
Hi, I'm Eric Pulaski. I run a couple of software companies. I've done some angel and venture investing. My question is, y'all have talked about equity, raising equity as well as debt, and talked about, one being more obviously debt is less expensive on the equity side, the dilution side. But of course, if you blow your covenants or you can't meet your interest payments, you can lose your whole company, right? So my question is, what are the things that you might look for to make a recommendation to a company as to when it's safe to take on that cheaper debt? Looking at what kind of buffer in terms of what it takes to meet your covenants, or what kind of buffer in terms of free cash flow to be able to make your payments. How do y'all think about that in making a recommendation to a business?
Yeah, I'll start with that. So, number one, it kind of goes to what I was saying about getting really good about preparing your 3 to 5 year model, and really testing that model is the other aspect. So you're going to run multiple models, right? You'll have one that you do maybe for yourself and your management team that's like this high growth case, right? And you're going to do one for Andrew because he's going to invest in you. You're going to do another one for us that's much more conservative. And it just goes to being a bank, right? We're conservative. We're going to look, and then we're going to take that case you gave me, and we're going to test that as well. So we're going to say, well, what if they don't grow the way they were going to say? What if their retention isn't as strong, right? What if their EBITDA margins are not 40%, but they're 20%? So we're going to test it and make sure that even on that much more sensitized case, that you're still able to meet the covenants that we set forth for you. So I would say get really good at being able to, run your models and being able to take a look at that and sort of thinking about, okay, how would those covenants particularly, impact the way I'm running the business? So that's how we look at those kind of situations. Is that helpful?
And I would just put a qualitative point on it is, if you have good insight into kind of the engine of your business, and there's if it's a tops-down software sales motion, if you have insight into kind of how repeatable that is, how predictable it is, we know these sales reps can ramp in this time and get to this kind of outcome, and we have demonstrated historical proof points of that, then I think that's a really good use case for debt. But if you're trying to build a product, build a platform that you are not sure how the market will kind of take it, then that's when maybe the quote more expensive equity is a better bet.
Maybe just one more thought is, we're seeing companies put a credit facility in place so that they can be opportunistic later. So that's another just nuance here, where you don't necessarily have to, maybe you feel good enough about it that you can negotiate good terms with your lender, but it doesn't necessarily mean that you have to draw it immediately. And so there may be a timing consideration there too, where maybe you set up the facility, but you don't actually draw it later. And then you wait until the moment in time when you have the opportunity to make an investment or do some inorganic growth or something. And then at that point in time, you take a look at the numbers again and see, am I really sure? And does this really make the kind of sense that we're talking about?
Yeah, that's a good point, Jen. Thank you. And I'd like to say thanks to the panelists for sitting up here and sharing their experience with you. And they'll be hopefully in the audience later if you have more questions for them. And Tom, thank you so much. We'll hand it over to you.
Thank you. Big round of applause for our panel.
Thanks, Linda.
Thanks for listening to the Austin Tech Connect podcast. Make sure your company is a member of the Austin Technology Council and add your voice to the future of our tech ecosystem in Central Texas.